Let's demystify deferred tax calculations and journal entries in this explainer so you can master your books.
We'll cover profit mismatches, core concepts, journal entries, and balance sheet classification. Let's dive right in.
The core conflict? Companies follow two completely different rule books that calculate profit in totally different ways.
For instance, differing depreciation rates under the Companies Act versus income tax create immediate profit mismatches.
But don't worry, over an asset's entire life, the total tax paid perfectly aligns under both.
This temporary year-by-year mismatch is exactly why we have to create deferred tax assets or liabilities.
So if your income tax is lower than your book tax today, you'll owe more tomorrow. Conversely, paying way more tax today than your books require actually secures a future tax benefit. Memorize this simple rule to instantly figure out if you're looking at an asset or a liability.
Okay, let's break down the actual journal entries in 3 simple steps using a practical example.
Imagine an 8 lakh taxable profit, a 3 lakh required book tax, and 2 lakhs prepaid.
First up, record the advance tax. Remember, this payment is an asset right now, not an expense.
Next, current tax. 30% on that 8 lakh taxable profit is exactly $240,000.
Create the provision by debiting profit and loss and crediting your current tax liability account.
Now, the crucial step. You've got to set off that advance tax against your new current liability.
This set-off leaves you with a net payable current tax liability of exactly 40,000 rupees.
But wait, our required book tax was 3 lakhs. That creates a massive 60,000 rupee gap.
Since we paid less tax today than our books mandate, we record a 60,000 rupee liability.
Finally, the balance sheet. Getting classification right here is absolutely critical for your year-end financial finalization. Your 40,000 rupee net current tax goes under current liabilities, since it's due within a year.
However, your deferred tax liability must always be strictly classified as a non-current item. Why? Well, deferred tax naturally sets off over several years as the underlying asset depreciates to zero. Always verify your math. Your current tax plus your deferred tax absolutely must equal total book tax.
So ask yourself, are your current tax savings hiding a future liability bomb on your balance sheet?